Larry, I've been looking forward to this conversation. How do you want to be positioned as a bond trader coming into tomorrow? What are you looking at?
Well, what I'm looking at is what's going to happen in the presser. Think about the January Fed Fund futures implying 66 basis points of cuts between now and the end of the year. If Powell does anything to compromise that assumption that the market has, and I think it's going to spell trouble for the market, or at least a pretty severe repricing.
You talking stocks?
Could be, because I feel like, why are we 3% above the October 2018 peak? I mean, there's nothing to warrant it other than the dovishness that we've had. And so I'm not saying that, Powell's not going to be able to be successful at feeding the doves. He's been doing it all year. It's just that it's how he does it. Put it this way. 66 basis points implied cuts between now and the end of the year. If he cuts 25 bips tomorrow and talks maybe at one more and done of a total of 50 basis points, I just don't think the market's going to be happy about that. I think it's going to be pretty good repricing, especially in the Treasury market. And obviously, not obviously, but I think intuitively, it'll spill over into the equity market as well.
So, all right, Larry, let's talk bonds here. I'm with you on equities. I think that's the most clear logic, is they need some pretty dovish words. But for bonds, I'm totally lost. And it seems like the market is pretty lost, too. It's been suspiciously quiet in the 10-year, for what? Like the past 3 weeks. Since
June.
Yeah. So, I mean, is this a market that needs to break out, or are we in an area right now that actually makes sense? I mean, tell me what's going on, because it was like rally, and then just kind of stopped.
Okay, so for the long end, the 10-year, obviously different than the 2-year or anything in the front end. It's really about inflation expectations. And, today was the most unremarkable day that we've seen in a long time. We've had some good data come out, but the 10-year yield doesn't really care. I mean, PCE, monthly was good, year on year, 1.6, seen that 4 times in a row, 9 months in a row of data below 2%, not even close to where it needs to be, although better than the March low of 1.54. So that said, we're in a holding pattern, and we just need some clear expectations with regards to inflation growth to get the 10-year one way or the other. Front end, obviously, a lot more tied into what Jay Powell does tomorrow, especially with the forward guidance in the press conference.
So the short term, if we bring up the 90-day IRX, Larry, obviously what you're saying shows up very obviously. Our yield curve relief, basically, from inversion has happened not because of the 10-year, but because that short term has moved south so quickly with expectations of that cut. So are we in for some volatility then if the 65 basis points you mentioned is priced in here as well?
We could be. I mean, it's hard to say that when you have every asset class you could think of, except for the British pound, is 40th percentile or lower, whether it be interest rates, FX, commodity vol, everything. Nobody seems to care at all. But that could change in a heartbeat tomorrow. We could think about it. If you have 66 basis points priced into the end of the year, and Powell, for whatever reason, makes it really clear that it's going to be one and done or 50 basis points and done, at the very minimum, you're going to see 16 basis points of repricing in the short end of the curve. And, I think the biggest move we had this year in the front end was probably 10 basis points. So it'd be a phenomenal move given what we've seen, which is nothing, especially since June.
Yeah. So to follow the logic on it that we've talked about before, if the inversion we've experienced is because the market is truly expressing an economic concern, right? And if it says, look, Jay, you need 65 bips to save us from, falling off a cliff, then by that logic, you would think bonds would rally if he doesn't be dovish enough. But that's the big question, right? Does the market really suggest that, or is there something else at play that might just be a speculative bid that blows off and yields spike?
Yes, and that's exactly how I'm trading it. It's not working out really well right now, but I am long 10s. Long 2s, short 10s.
Okay.
With the hope tomorrow's press conference talks more about open-ended being more, closer to 50 basis points to 1% or 75 basis points and 1%. Just giving a feeling that aura that there's going to be more than just 1 or 2 cuts. And if that happens, then we'll see a steepening that I continue to hold on to with regards to the 2-year versus the 10-year yield.
Yeah. All right. Good stuff, Larry. Always a fun conversation. Hey, before we let you go, if then, he does come through, though, since we're talking about the other side, let's be fair. Let's talk about the scenario in which he says, look, 65, you got it. 100, you got it. Whatever you want, I'm at your back. If that's the type of language we get, where do you want to be there? Just piling on top of a tank of gold or what?
No, I think you still want to be into the stock market, and I think you want to get back into the steepener trade. I think it's not as simple as that or as straightforward as that, but if the guidance is what you just said, then I see no reason to think otherwise, only because asset class volatilities are so low, the put from the Fed is in place, and so steepening, here we go.